All right. Good morning, everyone. Welcome to Commercial Wednesday, Top Agent Nation here. I'm Jeff Finn, CEO at RealNext, and delighted to be uh, hosting you all today and have a special guest, Tommy Brachey. And Tommy's got a fantastic service for those in the real estate industry that are working with clients that might be in need of tax deferred treatment for transactions, 1031, or other investment strategies. At Key Real Estate Consulting, they work with a unique asset type dealing with underground mineral rights and land that controls those. So it's real estate, but real estate in a different way than we traditionally think about it. And it's has a unique way of transacting that can benefit people that may not find a suitable replacement alternative in one of the exchanges that they're dealing with. And it's something that's always there and ready, which I think is fascinating about it. Something that you always have access to, and strong return profile and investment characteristics. So, Tommy, I'll let you sort of educate the group about what's the world of mineral rights and how it plays into this 1031 profile. And as always, we're recording this and open for questions. So if you have questions along the way, I know you can chat them and I'll direct them and engage, or we can wait. And if you have questions, you want to wait until the end, we'll have time at the end to deal with it that way. So, Tommy, great to have you here. Appreciate it. As you say, you're part of Key Real Estate, but also as many here are part of EXP. Tommy's part of the EXP family as well. So uh, yeah, I know he's looking forward to collaborating with all of you to help you with your business and growing and dealing with your clients.
Absolutely, Jeff. I appreciate the tee up. Yeah, my name's Tommy Brachey. Like you mentioned, I'm primarily focused on the 1031 exchange, kind of subset of the real estate market. But within that subset, as you also mentioned, I'm kind of in the deeded mineral property space or the mineral rights space. Um, it's good to be a part of the EXP family. It's been very welcoming to me. So I'd like to acknowledge all those folks with the EXP group as well. I have a presentation, but just a little bit about me. Um, I travel the country to put on 1031 exchange, like education events, as well as networking events. And also alongside 1031 exchanges, I also, target self-directed IRA and solo 401k type of crowds, whether you interact with, you know, uh, family offices, fund managers, estate planners, things of that nature too. There's opportunity with mineral rights and these deeded mineral properties there as well. But when I'm interacting with the brokers and agents, it's usually down the vein of the 1031 exchange where most of the value is provided. So with that being said, I'm gonna share my screen here, and then we can get started. Perfect. Jeff, you able to see my screen for the crowd?
You're good to go. It's good to me.
Perfect. Thank you. You'll see, obviously, you got my picture there, but I'm a published author on the subject here for 1031 exchanges as well as mineral rights. For anyone on the call, I'd be happy to either ship you a physical copy or send you a digital copy. It's whatever you prefer. At the bottom of the page there, it's kind of just rehashing. Yes, they're 1031 exchange compatible, which we'll focus on today, but they're also self-directed IRA and solo 401k compatible as well. So these slides are primarily intended for education purposes. If time permits or if questions come up, I'd be happy to dive into a deal to pair with this as context. But for now, we'll start with just the 30,000 foot view of, what makes this asset class special and how does it work. So the mineral rights, deeded mineral properties that we have that I usually interact with, they're oil and gas based. They're in the Permian Basin, which is West Texas and parts of southeastern New Mexico. But mineral rights as a general term does not limit itself to oil and natural gas. But for purposes of these properties, that is essentially what they're focused on. So you receive royalty checks when, these operators, and I'll try to avoid as many industry terms as possible. An operator is, think Chevron or Exxon. It's whoever is drilling or running the operations on the surface of your property. I'll use throughout this, given that we're having a broker and agent crowd today for the most part, I like to use the landlord-tenant relationships as a metaphor for when explaining how these work. So you'll see in that first bullet, you get royalty payments from the production every month. Think of that as rent, if you will. And if you're the owner of the deeded mineral property, you can think of yourself essentially as the landlord. So in this case, you could say Exxon is your tenant. They're the operator. They're giving you monthly royalty checks as the landlord. You could think of that as rent. It's a very, very strong parallel. So I'll keep that metaphor going throughout this presentation. As second bullet, every 30 days, you're getting that royalty check every month. That the third bullet there, it's mostly just contextual. This was a good old boys club, if you will, for a very long time. You're starting to see more people, especially over the last 10 to 15 years, take interest in this asset class, kind of at the retail level or at the individual and investor level. Usually they're real estate investors already, but not exclusively. You're seeing an uptick in the general portfolio of people that hold just their investment or their retirement portfolios has a sharp uptick in recent years in the number of what's considered alts or alternatives. While this is technically real estate because it is deeded title at the county clerk's office, just like a house, a commercial building, or a piece of raw land, it's tied to the commodity price of oil and to a lesser degree in this area, natural gas. But I'll get more into that here on a future slide. I like to, rip the Band-Aid off, so to speak, talking about the risks. Like any other asset class, it's not all sunshine and rainbows. There's really three main variables, so I define those as risks here. One is, like briefly mentioned a moment ago, this isn't tied to the traditional real estate market or the stock market, so it's looked at as an alternative or diversification play. It's tied to the commodity price of oil and, to a smaller degree, natural gas on these properties. So as all other variables held constant, if the price of oil goes up, you might grumble at the gas pump when it costs more to fill up your gas tank, but you're going to smile back inside from your mailbox when your royalty checks are significantly higher. The same applies to production volume, that second bullet there. Conversely, all other variables held constant, production volume goes up. And what that means is more barrels of oil extracted or harvested from your property in a given month means you're going to get a larger royalty check, and vice versa. Should production go down for whatever reason, that month's check will be reflected accordingly. The third bullet there, time exposure, that's kind of a lesser risk, but it is worth noting. Generally speaking, when we acquire the properties, and this isn't true for everybody, but part of our business model is we acquire properties with newly permitted wells that are above proven undeveloped reserves. And that's another industry term that I'll throw at you. It's a PUD, a PUD. It means proven undeveloped, meaning this is not an exploration or exploratory play. These resources are known and confirmed to be there by the Exxons and the Chevrons of the world. But what I mean by time exposure there is when a new well is permitted, it takes time before they go online and produce, and the mineral deed owner goes into what's referred to in the industry as pay status, which you can use common sense on that one. Pay status means you're receiving those monthly royalty checks, either via direct deposit or in the mailbox. But the time exposure there is sometimes it can take, a matter of months until a permitted well goes into pay status. So what does that mean for the mineral deed owner? When you acquire the property, if it exclusively only has permitted wells at the time you acquire it, one, that's attractive because you're getting all the flush production from the first, drop of oil that's produced on your property, which is what you want. However, it may take, 2, 3, 4 months until those wells are completed and you go into pay status. So that's the time exposure there, is that it may be a couple of months after acquiring the property until you start getting paid those monthly royalties. So that was the risks. The rest are mostly the positive aspects of this asset class as a whole. Some of it's Texas specific, which is where our properties are, and I'll make sure to notate that as I go through them. But unlike traditional real estate, and I'll refer to traditional real estate as your surface and above, your raw land, your structures, whether it be residential or commercial, right? So in the mineral deed asset class, you have no liability requirements, or exposure, I should say. You have no insurance requirements, no maintenance requirements. You don't pay for any of the costs of the operations that occur on the surface. That's a different line of the business. It's usually referred to as working interest or wildcatting. That's not what we're talking about today. That's more high risk, high reward side of the oil and gas business. I'd be happy to chat with you about that offline, but that is not the topic here today. That's that fourth bullet kind of just sums it all up. It's really a cash flow play. The drilling and operators on the surface assume the liability. They assume the maintenance. So that's one of the many facets that makes this asset class so attractive. For those of you, and most of us are in the traditional real estate space, it's like a passive triple net lease structure. You have no management or maintenance, like I mentioned earlier. That second bullet there, that's another tax perk of this asset class. It's baked into the Internal Revenue Code. It's referred to as the depletion allowance. It's specifically section 613 and 613A of the tax code. I don't have the whole tax code memorized like that, but I do know that. It's typically a commonly asked question when I'm putting on my educational seminars. But what the depletion allowance means for you is 15% of all of your royalty income is tax-free forever. So to keep the old metaphors going of landlords and tenants and traditional real estate, you can almost think of it like depreciation that you never have to recapture. It's just a tax perk baked into the tax code, period. So you'll never get a cash call like I mentioned, but you do get the upside. That's what that third bullet's referring to is, for the sake of example, let's say we have a 10 well package, if you will. And what that means is this property, this mineral property, has 10, say, permitted wells on the property that are imminently going online to produce. The sites that the mineral deed is the meets and bounds of the mineral deed may have room for 10 more wells that the operator has, suggested interest in adding to. So you might have a 10 well property that has potential for a 10 well upside, which means just 10 more future wells. When those wells are, installed, if you will, and the operations associated with getting them online, you assume none of those costs. You simply get paid when those wells go online for what they extract from your property. So what that essentially means in layman's terms is when those new wells go online, costs you nothing, and your monthly royalty checks go up based on those new wells production. And that fourth bullet, like I mentioned before, while this is technically deeded real estate, it's not tied to the traditional real estate market or the stock market. You now have, via a real estate deed, exposure to the oil and gas commodities. So this one's particularly interesting. This first bullet here, there's no traditional property tax on mineral properties in the state of Texas. There are ad valorem taxes that are incurred in the state of Texas, and they're very, very negligible. We had a $4 million property, just for your context, and the annual ad valorem tax bill on that was just a couple $1,000, and that's for the year. So for those of you familiar with Texas real estate, that's kind of where you get hit over the head from a tax perspective. Our taxes here in Texas, from a property tax perspective, are high. And they're just increasing as property values go up. You do not have that exposure eating into your cash flow if you exclusively own the subsurface, which is a reason why in this asset class, you don't want to own the surface level land, because then you get exposed to all those, you lose all those perks that we previously mentioned. You'll get hit with property tax. You'll get hit with insurance, potential maintenance, et cetera, et cetera. One thing on that third one is you're in complete control. There's nothing wrong with DSTs. They serve a great purpose. For those of you unfamiliar with the DST, it's a Delaware statutory trust. They're also 1031 exchange compatible. I work alongside a lot of those guys when I'm putting on my events. That way we can offer like kind of different flavors of ice cream, if you will, for people's 1031s. But a perk that the deeded minerals have over DSTs is there's no holding period. There's no lock-in period. Because keep in mind, this is technically deeded real estate. If you buy a house and you choose to sell it 3 weeks later, you could do that. It's yours to do what you want. Now, if you're wanting to 1031 back out, make sure that you're obeying the 1031 exchange requirements. Because with that being said, you can 1031 into this asset class and 1031 out. And that can be into another mineral property, or that can be back into traditional real estate. It's really up to you. What I've got bolded there is kind of the meat and potatoes that people really want to hear about. It's what are the typical returns, right? Like any other asset class, returns cannot be guaranteed, right? Keep in mind the risks that were mentioned before. It's tied to the commodity price of oil, to a lesser degree, natural gas in the Permian Basin for the most part, as well as production volumes. But with that being said, we typically see an average of 12 to 20% of ROI annually, paid monthly in a tax advantaged way, right? When I say tax advantaged, I'm referring to that depletion allowance we mentioned earlier. Also keep in mind that, oil and gas is technically a depleting asset, but there's a type curve that kind of, it's like a hockey stick for those of you familiar with looking at those curves. You want the first production. You want those permitted wells. It's not uncommon to see higher than that range in your first year and a half to 2 years. And then we kind of phrase it as it sobers up in that range that you see there. But generally speaking, when talking with clients, I'm in the under promise, over deliver game. So, we kind of suggest, while we can't guarantee, we typically see 12 to 20% annual ROI. I engage with all kinds of deal flow partners for this asset class. You technically don't have to be an accredited investor. Candidly speaking, I'd prefer that you were, but you don't have to be, because again, it's just deeded real estate. You don't have to be an accredited investor to buy a house. So that's why that applies here. I work, as you can see in the middle of that list, I primarily work with brokers and agents like yourselves. But there are opportunities aligning with business brokers, self-directed plan custodians like self-directed IRAs and solo 401ks that I mentioned before. Fund managers love the product for the cash flow aspect, and then they can take the cash flow themselves and disperse it based on, the agreements they have with their investors. Estate planners, financial advisors, that's another vertical for this asset class for those of you that may be in that space or have a network in that space. You have the classic estate planning dilemma, if you will. Let's not to be morbid, but let's just use an example of, maybe mom isn't doing so well. And she's doing some estate planning measures with a rental home that she owns or a commercial property that she owns, right? Son number one wants to keep it. Son number two wants nothing to do with it. He wants to sell it. Well, the option there is, or the estate planning move from a deeded mineral property perspective would be 1031 exchange that property, assuming it's compatible, into a mineral deed that's producing cash flow, kind of like that way you're not missing out on the rents that you might be accustomed to in that other property that you're 1031ing out of. Then when the time comes and it's time for her heirs to receive their, inheritance, son number one might receive his half or his unequal piece, depending on how the will was structured, of the mineral property, and he still wants to keep it. He likes the cash flow. He likes the asset. If son number two still wants to sell it, he has the wherewithal and the prerogative to do so. But the beauty of it this way is son number one is not impacted by what son number two chooses to do with it. His cash flow would be uninterrupted and unimpacted. So with that being said, that's kind of the educational piece. It's a lot of information. There are overlaps in traditional real estate, as you can see, but there is a lot of unique and nuanced aspects to this asset class as well. I always encourage everyone, do not try to common sense your way through this. If you've never seen it before, just give me a call. I'll do
Just a
the
quick
hand.
question on Tommy on that
Yeah.
estate planning issue.
Yeah.
Is it a divisible asset?
Yes, it
That
is. That's a
so,
great
and it
question.
could be like 50-50 or the third, two-thirds, or did the mom need to partition it when she made the acquisition?
She doesn't have to partition it when she makes the acquisition. It'd be part of and I would obviously defer to an estate planner to get the most accurate process order of operations for this. But essentially, she could, the mother in that example could, bequeath or will, unequal parts, 60% to son number one and 40% to son number two, or split it even further and, a third goes to son number one, a third goes to son number two, and a third goes to a charity or a church or what have you of her choosing.
But
So
then
that's definitely a great.
if the second, if somebody wanted to trade it, are they then a third owner or half owner in a property with the other son, or do they own their own
It's
piece?
standalone.
Standalone.
Standalone deed.
That's
Correct.
fantastic.
Yes. Yep. It's standalone. Your deed essentially entitles you to what's called NRI. Again, I try to avoid industry terms, but it's unavoidable to some degree. What NRI is the net royalty interest. So it's a pooled interest, but it's not, you're not sharing it uh in like a securities type of aspect. It's not, you don't have tenants in common or anything like that. It's the way this asset class works is you're deeded the real estate, you're given kind of like a meets and bounds over a property, and then you get a net royalty interest or a small percentage, depending on the amount you own, of the production on any given month on that property. There's a high degree of transparency there. A common question I get is, well, how do I know I'm not getting kind of bamboozled by the operator, if you will? The answer is it's heavily regulated and transparency is required. In Texas, um, the Texas Railroad Commissioner's Office oversees the energy production. And they have a publicly facing government website where you can type in, and it doesn't even require a login. So it's frictionless to get in there. Navigating the site can take a little bit of familiarity, but essentially, you go to the Texas Railroad Commissioner's Office page, you put in what's called an API number. That's kind of like a license plate or a social security number for each individual well that's on your property. And you're provided this information as a mineral deed owner. You can look up their production through inception. And it's usually about 60 days in arrears, the published data is. But for those that really want to dive into the numbers, and if you have a healthy degree of skepticism or anything like that, you're able to validate the numbers yourself. So that's it's not a comment I get too often, but it's worth noting that you can fact check anything you want in this space. But to reiterate a point you brought up before I dive into another slide here is the mineral deed asset class is very flexible, where traditional real estate usually is not, particularly when it comes to 1031 exchanges. And what I mean by that is, and I'll use some easy round numbers for the sake of example. Let's say it's a commercial transaction, $10 million exchange. You've got a $9.2 million replacement property already identified. Make it $9.2 million in some cents, right? Now you have $799,000 and say 10 cents remaining in boot money, leftover money exposed to capital gains taxes. Generally speaking, depending on your state and circumstances, let's just say you're going to lose about a third of that to capital gains. That's, hundreds of thousands of dollars. You might have a business need or a business strategy to take that hit, but most scenarios don't, but they're not aware of their options. But in the commercial space, you're probably not going to find something for $799,000 that you want to acquire just for the sake of deferring capital gains. So that's kind of where I provide value on the commercial side. To tie it back to your point, in the mineral deed asset class, I can bifurcate or split a mineral property or a mineral deed into separate standalone deeds. And they don't have to be equal sizes, just like in the estate planning example. So if I have a $4 million mineral property in the portfolio, and your scenario here in this 1031 exchange example, you have a $799,010 boot money exposed to capital gains. I can bifurcate from my $4 million property a separate standalone deed valued at $799,010 of mineral interest, therefore optimizing your 1031 exchange from a capital gains tax exposure perspective. But keep in mind, you're doing more than just defer those taxes. You're getting monthly cash flow from the operator in tax advantaged way with no overhead. And when I say no overhead, I'm including traditional property taxes as overhead, that you just don't have to take on. So that's where it becomes really attractive. Obviously, you can apply that to any degree of residential transaction as well. There's technically no minimum in the asset class. I usually tell, people it's about $100,000. That way, when you come to me with, a smaller transaction on the residential side of say, 60 or 70,000, I can accommodate that. But there is something to be said for splitting these properties up a little too small. I do have to maintain relationships with the operators, your Exxon, Chevrons, Conocos, et cetera, of the world. Um, and we just don't like to go too small because I have to submit division orders to those folks and deed transfers to let them know who to pay once one of our transactions is complete. All that's just a long way of saying there's technically not a minimum because remember, you don't have to be an accredited investor or anything like that. But we typically try to hover around the $100,000 mark as a minimum, as a soft line in the sand. Are there any other questions at this time? I can move forward.
It's just one more. I don't know if it's covered later.
Sure,
Is
go
it?
ahead.
Can you leverage it just like real estate, or how do you deal with the
Yeah.
fact that you sold something with 50, 60% debt on it, and can you
Mhm.
come in the same way?
So you technically can. But I will say we typically don't facilitate those transactions personally. We're kind of we acquire all of our properties in cash. We typically have at any given moment in the portfolio between $5 and $10 million, but we have a runway of significantly more than that. We just don't hold it all on our books. Um, we have the benefit here is we have the access in Midland and Odessa, Texas, which is West Texas, where the Permian Basin activity is. This might sound fancier than it needs to, and I'll tie this into the question, but this might sound fancier than it needs to. But the acquisition team that I work alongside is run by a geophysicist. Just regular guy. You'd never know he's a scientist, but that is his job, right? So it's kind of the secret sauce, if you will, in this space. Whereas, he wouldn't provide too much added value in traditional real estate. But given the fact that he's been doing this for about 25 years, specifically in the Permian Basin, it gives us the access to be able to have that runway to facilitate transactions that may exceed that $10+ million mark. But with that being said, we acquire our properties in cash because we just don't use any debt instruments ourselves. It lets us be nimble in these 1031 exchanges. I usually, make a comment or a joke even in my seminars where for those of you familiar with the 1031 exchanges, you know that there's a 45-day identification period, right? And I say, please do not come to me on day 45 on purpose. But it happens. It happens all the time. So that us having the properties outright like that lets me help in most cases, customers same day, even if it's day 45. But again, and including people on this call, please don't do that to me on purpose. But I am here to help. Um, but that all that is just to say that there are some specialized banks that'll kind of allow you to apply debt to these properties. They're usually smaller banks with specialized underwriters that will facilitate that. Just keep in mind those notes, generally speaking, are not as favorable as traditional real estate. And it also can slow down your transaction, just given the administrative processes involved with doing that. So the answer is technically yes, but for my purposes, we typically don't facilitate the debt related transactions.
I have a question, and Jeff, thank you for bringing Tommy to the table. Tommy, we had I'm April Lawson, and I actually met you in Dallas. We had the big EXP event there.
Yeah.
So as I'm looking at your books here, you were handing out the copies of the basics for the 1031 exchange. I want to just highly recommend to anyone on this call to definitely reach out to him. That book is just so cute and handy. I haven't read through it in its entirety, but as I was kind of fumbling through the pages a little bit, I was like, oh, wow, I can look like an expert just with this information. Reaching out
Well,
to you for the mineral rights book. Um, so here's my question.
yeah.
Um, so from my understanding, the 1031 exchange, generally you have to purchase like kind, like kind, as far as the exchange of properties. But maybe I missed something. What you're saying is if there's just a small amount left, or any amount left from the initial like-kind purchase,
Mhm.
they can take those funds and allocate it towards mineral rights. Did you say that
Yes,
right?
ma'am. Yes, ma'am. You
Okay,
did. You
so
said that perfectly. Yeah.
okay, and so my question is there some sort of what's that rule that kind of now says, or what's that rule that overrides the like kind
Sure.
purchase? I hope I'm
Sure.
asking the question
No, I
correctly.
totally understand your question, and it's a
Okay.
great question. And I usually bring it up in my seminars too. It kind of goes back to my comment earlier. First of all, thank you for your kind words. I really appreciate it, April. Um, but going back to I said earlier, do not try to common sense your way in this asset class. So a lot of these like laws and regulations were just that you just can't common sense your way through it. Is just the long and short of it. So like kind, do not use the common sense definition of like kind. Common sense for most people would say, well, you can only exchange raw land for raw land. You can only exchange a rental house for another rental house or a hotel for a hotel, et cetera, et cetera. But the reality is you can exchange raw land into a hotel or a hotel into a rental. It's considered like kind because it's deeded real estate or deeded real property for deeded real property. Well, mineral rights are deeded real property, just like at the county clerk's office. So it's not an exception to the rule. It follows the rule itself. Um, as far as the Internal Revenue Code is concerned, mineral rights are like kind, deeded mineral rights are like kind to a deeded house or a deeded hotel or a deeded piece of raw land. So there's actually no exception being made. It's just considered like kind in the eyes of the Internal Revenue Code.
Wow. Thank you. Glad I asked the question.
No, it's a great question. It is because again, it might violate common sense, but just the way that the Internal Revenue Code interprets like kind, it's compatible.
Thank
Great
you.
question. This might appear a little small on your screens here, and I can provide this to you, Jeff, or however you want to disseminate any materials. This is like a one pager. It's easy to digest. I usually hand it out at networking events and seminars. It's kind of just the highlights of what we've already covered. Just on the right hand side, just some bulleted like here are the perks. Here's how to contact me at the bottom from a phone number perspective. I post almost all my content on LinkedIn first. Feel free to reach out to me on there or by call or email. It's whatever your preference is. But I'll be happy to provide this out to all of you. And then briefly lost my mouse. There it is. So I also have digital copies of the two books that I have put out so far. I have a third one in the works that focuses on self-directed plans like self-directed IRAs and solo 401ks. For those of you with an interest in that, I can let you know when that's ready to go. And for anyone on the call, again, I'd be happy to send you these digital versions as well. I can actually show you a one pager. I think we have some time, Jeff, right?
We do. And if you could just supply these documents, we'll make it available for through the web links that Alejandro
Perfect.
will share.
Absolutely. Perfect. So I usually have a similar presentation for each available property that we kind of went through. Some of the slides are identical, but then there's going to be some slides that are property specific kind of wedged in between. For the interest of time, I'll just show you like a one pager. This is actually a currently available property. Um, it just gives you the breakdown from a high level of the property without going into like a formal pro forma, if you will. As you can see, it'll tell you like what the asset type is, its mineral rights, where it's located. Again, your ownership, it's deeded, which is what makes it 1031 compatible in the first place, and it's what gives you all the ultimate control. The production unit size, most are 640 acres in this asset class. Some of them are double of that at 1280. The operator, again, that's the industry term for who's drilling on your property. This is a company called SM Energy. They're a little smaller than your Exxons and your Chevrons, but they're small but mighty. If anybody's interested in learning about SM Energy, I'd be happy to chat with them offline as well. Here's a breakdown of the current wells. As you can see, there's 2 active. And then there's 6, another industry term, a DUC, a DUC means it's drilled, it's uncompleted, so it's imminent. And then there's other statuses for other wells here. And without getting into the weeds, I'll follow up with anybody that's interested, and I can have a more in-depth conversation. You might recall I mentioned upside before. 8 PUDs, 8 proven undeveloped wells. Essentially, what that means is there's a likelihood that SM Energy in this case will be able to add 8 additional wells in the near term. Just full disclosure there, near term, we don't have any way of knowing exactly when. That's an internal business decision at the operator level. It could be 3 months from now, could be 18 months, could be 2 years. So from a forecasting perspective, we don't include the PUDs when we're talking about ROI. That's kind of icing on the cake, if you will. Estimated economic life. We forecast the wells to last 20 years, but the reality is they usually go quite a bit longer. But just again, stay in that under promise, over deliver space is usually the best way to go. That recurring tax advantages, it refers to the depletion allowance. As you recall, it's 15% of your income's tax-free, period, forever. That's it, full stop. You don't have to recapture it or anything like that. The approximate initial cash flow from the new wells, you'll see here, if just some simple math here, that's your 6 ducts plus your 1 drilling and your 1 permitted in this case. At $65 oil, which I think oil's around, I haven't looked today, I think it's around 63-ish. Assuming you acquired this entire property at 1.5 million, you'd be looking at approximately $65,000 a month in tax advantage cash flow. It's not always as easy math as that. That's more of an incidental in this scenario for $65 oil to yield 65,000 per month. Just a little context for you there. Now, keep in mind, you see the purchase price of 1.5 million. Remember, we can deed down to the penny on this asset class. If you have a $201,000 1031 exchange need, again, I can bifurcate this deed into separate standalone deeds. You can identify the new standalone deed that I've bifurcated, valued at $201,000 of mineral interest or what have you. You'll see here approximately. Go ahead.
Just a quick question on that math. That looks like a 52% yield, not a 12 to 20% yield. Is that what you're saying? That initial bump?
I'm glad you brought that up. Yeah. So keep in mind on flush production, it's that initial bump, as you just put it. The initial cash flow is higher when new wells go online. Again, it's like a decline curve. I might actually have a slide I can show you to help illustrate this. But essentially, your first 12 to 24 months are what's usually referred to as flush production. Think of it as opening up a soda, like a Coca-Cola plastic bottle for the first time. That first time you open that lid, it's going to be the most pressure it's ever going to have again, even when you reseal it and reopen it. That's why you want permitted wells in this asset class, because you get that first drop or that first release of production. It's the highest pressure, if you will, to keep that analogy going. Again, we like to stay in the under promise, over deliver game. 12 to 20% is normal. After say year 2, well, say it kind of sobers up, if you will. That's why I phrase this as initial cash flow, and we can provide more specific breakdowns year by year on each of these properties. But just from a high level, you are correct in your assessment there. That's kind of just how the asset class works. It's front loaded. And then
Hey,
you have
Tommy, I have a question.
Brittany.
Sorry to interrupt. I was waiting for you to pause, but I don't want to forget this question.
Do your
Um,
thing.
I'm new to this call,
Mhm.
but what you were talking about, I do have like I'm trying to understand on what position you play in this because I have
Okay.
a listing. I'm in Dallas. I have a listing, a lot listing in Fort Worth, and my clients told me that they have leased it out to an energy company before, and they're willing to sell the mineral rights as well with it. But see, what you're explaining, I had no clue that this even existed, and I'm new to this side. And so I'm just trying to understand, do you all purchase the lots, or are you just, if someone purchased the land, then you're assisting and consulting them regarding the minerals? Like, I'm
Great
trying to
question.
understand what position you play here.
Yeah, no, great question. And it's looks like we have a pretty strong Dallas presence in here. That's pretty cool.
Mhm.
So essentially, I am the agent on the deal, is how you can look at it. We own these properties. So it's like a for sale by owner deeded real estate transaction, right? To answer your other question, and keep me honest here if I'm missing a piece of it, but what we do is it's not just advising, it's the deal itself, because these are in our portfolio, right? So as far as you mentioned purchasing the lot, we almost in no circumstance do we own the surface level lots. Because again, that comes with you know, property taxes, maintenance, insurance requirements, et cetera, et cetera. And it just eats into the cash flow. And candidly speaking, these properties being in West Texas in the Permian Basin, there's not a lot going on the surface anyway. So it's not really something that most people would be interested in acquiring from this perspective. There are other use cases for that. But as far as what I do, just this might give you a little more context to answer your question, Brittany, is I facilitate and target networking events with the brokers and realtors, because you guys have a rotating book of business of clients that are either in a 1031 exchange or will be in a 1031 exchange, or separately from 1031s might just be a real estate investor type looking to diversify their portfolio. For those that are entering a 1031 exchange or are currently in the 45-day identification period, I never try to talk people out of their already identified properties. My conversation, if they already have identified properties, just pertains to the boot. Some people like to stick with what they know, and I respect that. So but if they don't have an identified property, then it can be a different conversation to do a full replacement or a larger replacement. Brittany, does that answer your question, or did I miss any piece of it?
Yeah, in a way, you said that you have a portfolio, so that means that you're constantly looking to purchase mineral rights, not own the property or the land, correct?
Correct. You cut out a little bit there, but I'm almost positive I caught all
It,
that. So you are correct. There's an acquisition team that buys. It's called severed mineral rights. Most mineral rights in most of the country, generally speaking, are severed. It's pretty rare these days that when you're buying or selling a house, you're also getting bundled in the mineral rights these days. It does happen though, so don't get me wrong there. But you are correct. I work alongside a mineral acquisition team that is constantly acquiring severed mineral rights, again, almost exclusively in the Permian Basin in West Texas. But when you have me step in at these networking events and seminars and kind of webinars like this, I'm kind of educating the brokers and realtors and some other roles as well, of this as kind of being an option. So then I kind of act as the divesting arm, as opposed to being the acquisition arm. Does that cross the T's and dot the I's, Brittany?
yeah, it does. It does. I definitely would want to connect more with you to share my listing and see what we can do or how we can make this work.
Yeah, no, I'd be happy to. And again, this is for not just you, but for everyone. There are no dumb questions in this space. Do not common sense your way through it. Sometimes common sense will fail you. There's just some things just are what they are, in traditional real estate and in the mineral rights space alike. So I encourage you to ask away if you think it's silly. We'll just rip that Band-Aid off, get it all out in the open. I'm happy to answer anything. With that being said, I know we're kind of knocking on the door of time. Other than just interesting information, other than just being a niche asset class, we do compensate for deal flow. So that's what's in it for the brokers and agents. Similar to traditional real estate, we can get a fee. Usually it's, a few percentage points on the deal. So for those of you that, are in a 1031 exchange with your clients, there's a way for you to get paid on the transaction itself if they have a replacement property that you're getting for them, or if you're on the other end of the exchange and you're helping them sell the property. If you make an introduction to me, and that's all I require is an introduction. I don't expect anybody to be an expert. That's kind of what my job is, to be honest. Then, there's some incentivized deal flow that we can be engaged in together. And we typically also partner up with brokers and realtors and agents in the sense of repeat business. Brittany, I'll use you as an example since we just chatted. You know, if you referred me a client and they closed, obviously you're incentivized for that. But if your client came back to me in 6 months or 18 months and they don't go through you, they come directly to me. You know, I keep you in my CRM. And if they close another deal, you're incentivized for that too. Kind of just keeping things incentivized for everybody leads to more deal flow. And we structure the deals to be able to have enough meat on the bone for agents to be able to eat too, so to speak. So
That's excellent. Tommy, one more question I have, and then certainly open for more questions from the group if anybody has any. But are these assets worthless at the end of their life, or and what's the declining sort of balance, and how liquid are they along the way to get to any
great.
type of residual value?
Yep. No, great question. It's funny you say that actually. Let me actually go through one of these other slides here. I have a slide called residual value. There we go. So this is usually just for your context for those of you watching, this is from like this slide is usually not in my abridged version. This slide is usually in like a property specific deck when I'm going into a little more detail than we've been able to today. But the residual value here is in a fairy tale textbook example, Jeff, what you described would be true. When the wells are done, the property is worthless. However, that's not the reality, especially not in the Permian Basin. So what actually happens is new wells over time are going to constantly be, you know, reassessed and added. Kind of like the additional upside that we looked in the example, there was 8 PUDs, essentially 8 potential, you know, new wells in the near term. The technology in this space is greatly increasing, not just from an efficiency perspective, but from a mineral detection perspective. You'll see here, the primary objectives on this particular property that I'm sharing is referred to as the Lower Sprayberry and the Wolfcamp A. You'll see, well, there's the Dean Formation, the Joe Mill, all these other variations of the Wolfcamp. When the operator decides to go after those, well, they're going to have to get new wells. You're entitled to everything to the core of the earth. And there's more formations than pictured here, by the way. So as far as residual value, you're looking at decades of residual value. As soon as the technology improves, they might revisit Lower Sprayberry. Like, hey, we found more pockets of resources there. We're going to extract them and you get paid on it. That's generally how the space works. It can be a long-term hold with a lot of residual value, but for those that, you know, have other needs or other wishes, again, you're in control, which gets to your other point or your other question. You can sell it whenever you want. Generally speaking, there is a secondary market for it. I don't require by any stretch of the imagination you to go through me if you decide to sell it, but I can help you with that. There is a secondary market. U.S. Mineral Exchange is one of them. Not to knock on them, but their fees are pretty high. And we have an existing kind of boots on the ground, so to speak, network in the Permian Basin. By the way, in this graphic, the Permian Basin split into 2. There's a Midland side of the basin and a Delaware side of the basin. So this graphic reflects the Permian Basin collectively. But, you know, with that being said, you know, feel free to go through me and I'd be happy to do some hand holding on any divesting on your end as well. So in that sense, it's technically not liquid in the financial term of liquidity, just like real estate itself is not. But as far as divesting it, it's not difficult, generally speaking. Did we have any other questions in the chat? I don't have it visible on my.
Don't see any other questions. I'll give you a couple minutes to get them in if you do. And
Sure. Yeah.
Tommy, if you don't have any final words, how do you maybe take on that QR code if you want contact information and access to the books? But if you could circulate them to it gets Alejandra, she can get them out to the group so everyone will have links to your digital assets that you talked about.
That's perfect. Yeah, Alejandro, I'll get those over to you. But yeah, just to recap from a contact perspective, you know, keyrealestateconsulting.com is my primary website. I'm active on LinkedIn for those of you that use it. I encourage brokers and agents to use it. I know Instagram might be a little superior in the traditional real estate market. But just for your context, I found that LinkedIn's a very powerful tool. You know, from a from not just a commercial side, but from mineral rights as well. Feel free to email me, mgmt, short for management, at keyrealestateconsulting.com. And that phone number there, 214-998-8198. That goes directly to my iPhone. Feel free to call or text that as you if you have any questions and prefer to communicate in that method. With that being said, I think that's about it for me. I'm happy to hang out if any questions pop up, but
I think we're good. We gave
appreciate-
everybody their chance. Appreciate you, Tommy. Appreciate the forum. That's we have here, and everyone joining us today, and look for and people that join it and the recorded version as well. And look forward to seeing you all in future sessions.
Absolutely.
Thanks,
Thank you.
everybody.